Silvergate Bank, Deep Dive, Part 2. What happened? What happened? The stunning dethroning of the king bank of crypto, Silvergate, begins with the downfall of the idiot savant of crypto, Sam Bankman-Fried, SBF, his initials as he's known by. There he is. And his spawns, FTX and Alameda Research. As the white glove Swiss finance allegory to traditional banking in the crypto space, Silvergate was the institution FTX and Alameda relied on to keep safe their depositor funds, along with most of the crypto industry. But Silvergate was only minimally exposed to FTX's failing, since they didn't accept FTT coins as collateral. SBF was gambling with Alameda's funds, which worked out well when the crypto space was on its 2021 parabolic bull run. But when the crypto space started crashing, the bets turned sour. And FTX's own FTT tokens, which had previously served as a money printing machine, dried up. Basically, SBF went on a multi-billion-dollar personal gambling streak on trades through Alameda, and then lost much of FTX's liquid capital in the process. Liquid capital loaned by FTX to Alameda and approved by SBF, tokens created out of thin air by SBF. And they weren't liquid, since liquidity was low, and to even sell a few $1,000,000 worth would collapse the price and the valuation of the reserve holdings, revealing that FTX was already essentially insolvent. So those tokens, along with other digital currencies, were given to FTX by Alameda as collateral for loans. And the only liquid cash FTX had to loan at that point was customer deposits, which its terms and conditions stated would never be used for that purpose. Like a gambler betting his house and his wife on a double or nothing, SBF was reckless and cavalier at the end. There were no checks and balances because he had installed backdoors and overrides into the system for his personal use. Alameda was not susceptible to the margin calls that everyone else trading on the FTX exchange were. Silvergate was the caretaker of the funds and is currently facing an anti-money laundering investigation, AML, and a civil lawsuit over its actions. It remains to be seen if there's any liability there, but with the overrides it could not have known about, reasonably expected, or planned for, it's a challenging case to make from what we currently know, which is not all that much. So take that with a grain of salt. One reason Silvergate stock has faced so much pressure is because of these uncertainties. While this was going on behind the scenes, someone had tipped off CoinDesk that things were amiss at Alameda Research, which was always just a business-sounding name for the truth, SBF's piggy bank and trading account. Here's the timeline. November 2nd, CoinDesk reports Alameda Research and FTX has closer than arm's length relationship, and that Alameda is primarily capitalized by FTT, made out of thin air. Many people believe it was CZ, the head of Binance, that orchestrated the CoinDesk article and much of the FTX run that followed. That's CZ there. November 7th, Binance, who held $529 million of FTT, which is run by CZ, from a repurchase by SBF of an early equity stake it had taken in FTX, a venture capital stake in its early days, publicly announced it was selling it all based on concerns brought up by the CoinDesk article. This caused the price of FTT to lose significant value. Now remember, this was the collateral FTX had accepted from Alameda in exchange for customer cash deposits, which SBF had lost to the tune of $8 billion. In addition to crashing the price of FTT, the CoinDesk concerns, now amplified by Binance, led to withdrawal requests of $6 billion cash within the next 72 hours. But FTX didn't have $6 billion cash. It loaned it to Alameda, remember? And all it had was FTT collateral that was illiquid and that SBF had made up out of thin air and printed as many as he wanted. On November 8th, Binance chief, CZ, as we've been talking about, having personally created the urgent situation at FTX, and as it has been widely speculated, likely planted the story in CoinDesk, which he then used as a cudgel, playing SBF like a cheap harmonica. He made a deal with SBF who was forced to announce that FTX could not honor withdrawal requests that morning, outlined in a non-binding letter of intent to purchase FTX and make depositors whole. In the press release, CZ said that during the due diligence phase, the price of FTT was likely to become volatile and to avoid using it at all if possible. This, of course, led to panic, and FTT absolutely collapsed, losing another 80% of its value and erasing any hope that the collateral could ever be used to pay back those Alameda loans. The next day, November 9th, Bloomberg and the Wall Street Journal both reported Binance had decided not to complete the deal. SBF learned about this from those media reports. CZ did not contact him and clue him in. On November 10th, SBF approached Kraken for a bailout. It failed. Bank of America downgraded Silvergate stock based on perceived contagion with FTX. The day after that, November 11th, FTX, FTX.US, their US arm, and Alameda Research all filed for bankruptcy. Silvergate released a statement saying FTX accounted for less than 10% of its total deposits. So its exposure was limited. In mid-November, short sellers shorting companies relating to FTX included Silvergate and BlockFi. They then started rumors on Twitter and other social media about possible bank runs, leading to self-fulfilling panic withdrawals. On November 28th, BlockFi filed for bankruptcy. Silvergate said they had no outstanding loans to BlockFi, so no exposure. SBF admitted that Alameda funds from FTX sent through Silvergate Bank that day, and Senators Warren and Marshall and Kennedy sent a letter to Silvergate asking for all records related to FTX. On December 5th, Silvergate's share price collapsed 89% from its high to $25. Deposits fell from about $12 billion to $3.8 billion, a loss of roughly $8 billion. December 31st, Silvergate reports that it had to sell treasuries to cover withdrawals at a steep discount to face value due to much higher interest rates, treasury bonds being issued compared to the interest rates on the T-bills when they had purchased them. That resulted in a loss for the fourth quarter of roughly $1 billion. On January 4th, Judge Dorsey, who was in charge of the FTX bankruptcy case that had been initiated by that point, ordered that funds be seized from Silvergate and other institutional accounts for benefit of FTX. January 5th, Silvergate announced their $718 million loss officially from the sale of treasuries to cover withdrawals. And ARK Invests, a hedge fund with Kathy Woods, announced divestment of $5 million of SI stock. And that day, Marathon Digital said that it paid off a $50 million line of credit to end their relationship with Silvergate. JP Morgan downgraded SI stock from buy to neutral with a target of $14, and Moody's downgraded their bonds the next day, January 6th. On January 17th, Silvergate reported initially a loss of $1 billion in quarter four. These weren't audited results. In fact, they delayed their audited results. On January 27th, Silvergate suspended dividends for the preferred stock. On February 14th, Silvergate announced a delay on filing their annual report and said it was evaluating its ability to operate as an ongoing concern. On March 2nd, Coinbase and Galaxy Digital dropped Silvergate as a banking partner. March 3rd, Silvergate announced a risk-based decision to cease operation of Silvergate Exchange Network, which was the backbone of their entire crypto fiat operation. On March 6th, multiple clients of Silvergate publicly announced that they have ended their business relationship with the bank. It had become a pariah at that point. March 8th, Silvergate announced it had decided to voluntarily liquidate the bank and cease operations of the bank, but not the holding company, which is what the stock represents. The bank is a subsidiary. So there we are. And next part of the series is part 3.